Have you ever wondered how the giant buildings that shape our cities are bought and sold? We see them every day. Warehouses, office parks, high-tech labs. But behind the scenes, there's a high-stakes game of chess being played by massive investment firms. And what if I told you that selling off a portfolio of properties worth hundreds of millions of dollars could actually be one of the smartest moves a company can make? Well, that's exactly what just happened in Singapore. One of the biggest players in the real estate game, CapitaLand Ascendas REIT, just made a massive move. They announced the sale of 5 industrial and logistics properties for a whopping 329 million Singapore dollars. Today, we're diving deep into a special research report that breaks down this entire deal. We'll uncover the masterclass strategy behind this sale, where all that money is going, and what powerful signals it sends about the future of real estate and the global economy. But first, let's get this out of the way. This video is for educational purposes only and should not be considered financial advice. Please do your own research or consult a licensed professional before making any financial decisions. All right, with that covered, let's set the stage. The main player here is CapitaLand Ascendas REIT. As many of you know, CLAR is an absolute giant in the industry. It's Singapore's first and largest listed business space and industrial REIT. Their portfolio is immense, with over 200 properties spread across key developed markets like Singapore, Australia, the United States, and Europe, valued at a staggering 16.8 billion SGD dollars. So when a player of this size makes a calculated move, the market pays very close attention. On August 18, 2025, they announced the sale of 5 of their Singapore properties. And the buyers weren't just anybody. A major institutional consortium backed by big names like Hillhouse Investment and Partners Group stepped in. This immediately tells us that sophisticated, big money investors are hungry for Singaporean real estate. But the real story isn't just the sale itself, it's the why. This $329 million Singapore deal is a textbook execution of a core investment strategy called capital recycling. Think of it like a pro sports team manager trading a solid, reliable veteran player to free up salary cap space to sign the next generational superstar. It's a strategic sacrifice for a much bigger win down the road. CLAR is doing exactly that, but with buildings. So let's break this down. First, we'll look at what they sold and why. It was a genius move. The strategy, capital recycling, sounds complex, but it's really about being proactive. Instead of just holding on to properties forever, you strategically sell certain assets, maybe older ones or ones in slower growth sectors, to free up cash. Then you reinvest that cash, or recycle it, into new opportunities with higher growth potential. Let's get specific about what CLAR sold. These weren't bad properties, but they had certain characteristics that made them perfect candidates for this strategy. The report highlights 2 critical details. Their weighted average lease expiry, or WALE, was only about 1.6 years. In simple terms, this means that the tenant contracts were coming up for renewal very soon, which introduces risk and uncertainty. Second, and perhaps more importantly, the properties had an average remaining land lease of only 27 years. In a place like Singapore, where most industrial land is on a fixed-term lease from the government, this is a ticking clock. As that lease gets shorter, the long-term value of the property can decline. So CLAR identified these assets as being less aligned with their long-term vision for a future-proof portfolio. And the timing of their sale was impeccable. They sold the 5 properties for a combined $329 million Singapore dollar, which was 6% above their official market valuation. Even better, it was a 20% premium over what they originally paid for them. That's a fantastic capital gain. They successfully sold their veteran players at the peak of their trade value. Interestingly, if you look at the individual sales, one property, 10 To Guan Road, was actually sold for an 8% loss compared to its original purchase price. So why would they do that? Because the strategy isn't about maximizing profit on every single asset. It's about optimizing the entire portfolio. The huge gains on the other properties more than made up for this small loss, and the move allowed them to achieve their larger strategic goal of exiting assets with shorter lease tenures. It's a sign of disciplined, big-picture management. Now, for the most exciting part, where is that $313 million Singapore dollar in cash going? This is where we see CALR's vision for the future, and it's all about what the report calls new economy assets. Their shopping spree is focused on two key areas. First, they're expanding aggressively in the United Kingdom. They're investing $350 million Singapore dollar to develop 4 brand new, top-of-the-line logistics properties. These aren't just any warehouses. They're being built in the East Midlands, a prime logistics hub in the UK. They will be modern, green certified, and designed specifically for the demands of e-commerce and 21st century supply chains. Crucially, the land they acquired is freehold. This is a massive strategic advantage as it eliminates the risk of a lease expiring, which was the very reason they sold the Singapore assets. This move is a direct bet on the unstoppable growth of online shopping. Second, they're doubling down on technology and science back home in Singapore. They've committed over $700 million Singapore dollar to acquire 2 incredible properties, a Tier 3 data center and a premium business park designed for life sciences companies. Let's think about that for a moment. Data is the new oil. Everything we do online, from streaming movies to cloud computing to the AI revolution, runs on physical data centers. The demand for this space is exploding. At the same time, with global health advancements and aging populations, the life sciences and biotech sectors are also in a massive growth phase, so you can clearly see the playbook. Sell older industrial buildings with short lease lives, reinvest the profits into freehold logistics hubs powering e-commerce and high-tech data centers and life science parks powering our digital and biological future. The report also highlights that these new acquisitions are expected to be DPU accretive. For those who follow REITs, you know this is the holy grail. It means these new investments are projected to increase the cash distributions paid out to unit holders. So not only is the strategy strengthening the portfolio for the long term, but it's also expected to deliver higher returns to investors. So what does a massive strategic pivot like this mean for the wider market? A move this big from a market leader like CALR sends powerful ripples. First, it's a massive vote of confidence in the Singapore industrial real estate market. The fact that major global investors were eager to pay a premium for these assets shows that Singapore is still seen as a resilient, safe haven for capital amidst global economic uncertainty. The report points to some incredible data supporting this. In the second quarter of 2025, transaction value in Singapore's industrial sector surged more than 6-fold from the previous quarter, hitting $1.44 billion Singapore dollar. This wasn't a fluke. It was driven by strong S-REIT activity and institutional demand. Second, this move highlights a critical trend in real estate, the flight to quality. Investors are no longer satisfied with just any building. They want modern, energy-efficient, green-certified properties located in high-growth sectors. The days of passively holding an old factory are over. The future is in specialized, high-spec assets that cater to the new economy. CALR is positioning themselves right at the forefront of this trend. Finally, this strategy is a big bet on the future of Singapore's economy. The government's focus on advanced manufacturing, the global electronics upcycle, and the growing demand for AI data centers all create powerful tailwinds. Furthermore, the China Plus One supply chain diversification trend, where companies actively seek manufacturing and logistics spaces outside of China, directly benefits Singapore. CALR's investments are perfectly aligned to ride these powerful waves. So, to bring it all home, this $329 million Singapore dollar divestment was far from a sign of weakness. It was a bold, decisive, and brilliantly executed strategic pivot. It's a masterclass in proactive portfolio management.
They traded good assets of today for elite assets of tomorrow, unlocking significant value for shareholders and positioning their portfolio for a future defined by technology, e-commerce, and science. All right, so to quickly recap, CapitaLand Ascendas REIT sold 5 older properties for a cool $329 million Singapore dollar, locking in a solid profit. They're using the brilliant capital recycling strategy to reinvest that money into future-proof sectors like UK logistics and Singapore data centers. And this entire move highlights the incredible strength and forward-looking nature of Singapore's industrial real estate market. It's a textbook example of how not just to play the game, but to shape it. If you found this deep dive useful and learned something new today, don't forget to hit that like button, subscribe to the channel, and maybe even share it with a friend who's interested in business or investing. And I'd love to hear your thoughts in the comments below.
What do you think of this capital recycling strategy? Thank you so much for watching.